Hey guys, hope you're all doing well. In this video, I want to share with you my numbers behind Facebook stock and show you why I like Facebook's valuation. But before everything, I want to have a talk with retail investor community. I believe that us retail investors should not be moving in and out of a stock too much. We should be long-term investors. However, for the past 6 months, I've seen a lot of investors moving from long-term investing to short-term tradings based on news like interest rates, Ukraine, or a lot of things like that. I believe that whatever news that I can find in the internet, that news is already priced in the stock. There are a lot of investment funds out there with a lot of resources. I won't try to beat them by following the news. That may work for a short period of time, maybe a year, 2 years, maybe 5 years, but over 20 years, you can't consistently outperform hedge funds by just following the news, at least in my opinion. I believe us as retail investors, we should find new thoughts and new opinions. We shouldn't be looking for deals in the market by looking for good news and bad news. We need to read 10K and 10Q report to make a conclusion based on our own knowledge, not by what you can find in the media. You may get lucky copycatting an investor for a while, but that won't work long term. Remember, not everybody can become a successful individual stock picker. There's always the option of ETFs, index funds, or mutual funds. So here, I'm not going to share my research behind the Facebook stock. I'm only going to share with you the numbers and the valuation part of my research. There's not enough time for me to share the research because that's going to be almost a 45 minutes video, I think. And the 45 minutes video, it's going to be 45 minutes video for you to watch. It's going to be like 10-15 hours for me to make. If you're interested and if you ask for it in the comment section, I can create that video. But for now, let's just focus on the valuation part. The total revenue for Facebook in 2021 was this number. If you divide this number by the current market cap, which is this number, we'll get to this number, 5.14. That's called price to sales ratio. This is a perfect price to sales ratio. By perfect, I mean cheap. This is a really nice price to sales ratio that I want to see when I'm researching a stock, because this company has been growing around 15, 20, 25% consistently for the past almost a decade. And it's not just a small market cap cheap company. It's a well-established company. For such a company, around 5 price to sales ratio is called cheap, in my opinion. Now, the net revenue for 2021 was this number. If you again divide the market cap by the net revenue, you will get to 15.41. This is the P ratio for Facebook stock as of right now. This company is expected to grow 20% this year and 17% next year. If the company's revenue grows 12% as analysts expect, the stock price should also grow 12% to keep the 15.41 P ratio. And also for the next year, analysts expect this company to grow 17%. So the stock price should also grow around 17% to keep the same P ratio. This is a basic valuation that I always do in back of my mind when I'm researching a stock. Now, if analysts start to lower their expected growth number from, let's say, 12% to 5%, the company is gonna grow 5%. But that doesn't mean the stock price is gonna grow 5%, because the 15P ratio is for a company that is growing between 10 to 20% every year. If the company is not growing that much and it is growing in lower rates, then the P ratio has to come down from, let's say, 15 to 10. That's a scenario in which the stock price can be lower in a year or two based on this situation that I just explained. Anyway, based on the things that I just shared, I want to share with you my numbers behind the Facebook stock. Well, so what do we have here? We have the current market cap for Facebook as of right now is around $606 billion. And we also have the historical revenue numbers that go back to 2017. We have a list of profit margins and the P ratio. Actually, not a list, a range. So for the profit margins, 26% to 35%, and they also can go around 12% to 45%, but the mid-range is around 26% to 35%. Now, for those of you who saw my Apple valuation video, you probably remember that the profit margins for Apple's business is way lower than Facebook's business. You have to understand that Apple is selling a product. There are a lot of costs associated when selling a product. You have to contact a lot of vendors to make different parts. There are shipments, costs of shipping, or engineers or designers. There are a lot of costs associated with that. However, on the other hand, Facebook is an advertisement company. Yes, they have engineers, they have costs, but the costs are not like having to sell a physical product like iPhones or anything like that. You get the idea. That's why the profit margins for an online business like Facebook is way better than a traditional business like Apple. However, Apple is kind of a needs-based company. People are gonna buy Apples even if they don't have too much money on hand, because they need a phone, they need a computer. They're gonna buy it however they can. Yes, in a recession scenario, Apple's sales numbers are gonna come down, but not that much compared to Facebook. Facebook is more volatile. The revenue numbers is more volatile. When we are in a recession, companies are not gonna advertise because they know people, first of all, don't have that much money because the countries are in a recession. And companies also are gonna go through a rough path that they won't have enough capital to invest in advertisement. The less companies pay for the advertisement, the less Facebook is gonna make money. That's why even though the profit margins are higher, the revenue number is more volatile. So in short, companies are gonna cut their advertisement budget when we are in a recession, and that's probably why Facebook is so much lower than its 52-week high. In my opinion, this is a temporary situation that can last up to 2 years, but it is temporary. This is not a normal situation that we are in right now. Maybe in 5 years, maybe in 10 years, we're going to be back to normal. I'm not trying to predict it, but I know that we will one day reach to the normal situation that we had before. It may take a few years, but that's how I can invest for the long term. I'm not trying to time the market. I'm not trying to make a trade here. I'm investing in a company that I believe it's cheap right now based on the history and the values that this company is bringing to this world. Anyway, that was the range of profit margins. Usually companies right now are in their mid-low profit margins because of all the, supply and chain issue. Their costs have increased. However, since this is more of an online business, the profit margins right now is sitting at 30%. It's a bit closer to mid-low than mid-high, but it's essentially in the middle. Anyway, the P ratio. Again, this is the historical P ratio for this company. You can see that we are sitting on the lowest number for like ever, 16 P ratio based on this chart right now. But I remember this stock is usually being traded at around 25, 30 P ratio. And 15, 16, it's just a joke. So the range that I'm considering here is this. The low and high is like 10 to 40, but the mid-low and mid-high is around 14 to 31. Now, here we come to the forecasting the revenue numbers for the upcoming years. In this valuation, based on this forecast method, I wanna again, as always, use the lower confidence bound to kind of under promise to myself and over deliver in the future. So we go back to lower bound, especially with the recession situation thingy that we are in right now. It's really good to just consider the lower bound here. So if you know what analysts expect this company to grow, this number is even lower than the lowest estimated growth for this company. So this is the perfect thing to choose, the lower bound. Anyway, we have the profit margins and the P ratio. So here are the expected growth for this company. You can see over the period of almost 4 years. In the good case scenario, we can potentially gain 230% return on our capital. For the bad case scenario is 5.25%. And remember, for the bad case scenario, the P ratio should be 14. The profit margins should also be 26. And yeah, this is possible. For every valuation that I have, the range of between bad case and good case scenario, any round number in my opinion is possible. We can potentially gain only 5% in a period of 4 years, but that's unlikely. That's really unlikely. I believe this stock can grow something in between, which is around 110, I think. Yeah, 109, 110% growth in our stock price over a period of 4 years, which annualized it's around like let's say 34, 35, 17.5% annualized growth, which is again a perfect number in my opinion for investing in such a safe company. I want to also jump to the forecast method, not the lower or upper band, just the normal forecast method. You can see in here the numbers are a bit better. Over the case of 4 years, the bad case scenario is around 13% in 4 years, which is annualized of 3%. This is a dividend. This is just like a dividend that a lot of companies pay. So again, any company that I do the valuation and it is positive for the bad case scenario in 4 years, it's good. It's a good investment. In my opinion, it's a good investment. I'm not gonna invest like 80% of money in this company, obviously, but if I'm investing in more riskier assets, I also need some safer companies like this so that I can be sure that I'm not gonna lose a fortune in case of, I don't know, a world war or I don't know, interest rate increase. I don't know. It's always good to have a safe stock in your portfolio. That's how I think about it. That's it, guys. Hope you got a lot of value from this video. Be sure to subscribe, and that's it. See you with the next video.